Hello, I'm here today with Mark Bourke, CEO of IFG Group. Mark, the market expectation has been that SIPP growth would be double-digit for many years, supported by an ageing population, increasing self-provision, tax incentives and product development. In your recent seminar, Towers Watson presented a much slower outlook up to 2016. Were they being overly conservative? And if not, how have your plans changed to take into account this slower market growth?
The market expectations over a number of years have been considered to be double-digit, but we were unsure of the foundations and believed that we should do a robust piece of work to establish whether the market was sustainable. We asked Towers to do this, and they built essentially a number of scenarios, a number of models. And I think they answered for us the key underlying question, which was, is there going to be sustainable growth in this market? That for us was the most important question answered. The second part of the question was, does our plan change? Our plans are to essentially punch our weight in this market. James Hay traditionally owned the SIPP market, then it lost its way, and we really are about reinvigorating the brand, rebuilding our distribution, and capturing a much greater percentage. So we have unchanged plans, and we have a market which we expect to grow.
Mm-hmm. RDR will drive down pricing at the same time as other regulations push up the amount of capital that you hold. Mm-hmm. How will you offset these pressures to maintain your returns?
RDR is not necessarily going to drive down all pricing. What RDR will do in this market is it will bring clarity, it will bring transparency ultimately for the end customer. So we would believe that the mission of a business like ours is to provide value ultimately to the end customer or to the IFA who serves that end customer. So our whole strategy is about finding ways in which we help the advisor to service that customer, to make that more streamlined, and to add value ultimately to his proposition. Where we are potentially dealing directly with the customer, it's exactly the same proposition. So I think that RDR will remove areas where people are essentially being rewarded without providing value. However, RDR will actually reward ultimately those who do provide value for the end customer.
Wrapped products appear likely to continue to grow, and you have outlined a possible strategy to evolve from being a SIPP provider to a wrap platform player. How are you going to compete with a Hargreaves Lansdown, which has got the low-cost platform, the products, the customers and the brand?
James Hay, in fact, has always had wrap capability. And as a business which has concentrated on the higher net worth customer, building that wrap capability would have happened in the early 2000s. Mm-hmm. As a business, it's a natural progression to have a platform underlying your SIPP capability where you can provide increasingly complex methods of wrapping customer assets. We don't see ourselves ever as competing with Hargreaves Lansdown. It's a simple, market-driven platform which is exceptionally good in its space. We're concentrated very much on the higher net worth end of the market. Mm-hmm. For us, building out the wrap is really about building wrap capability for the IFA, but also potentially for the direct customer, and adding for them the tools to allow them to build their own portfolio, or again, for the IFA, giving him the ability to service his customer more efficiently, with more, essentially with more tools to help him build the client's assets.
You've clearly transformed the James Hay business with state-of-the-art technology and delivery, improved sales and distribution, and much higher service levels. Some of this is in your improving sales volumes, but how much more can we expect, and over what timescale? The
buying of James Hay happened in 2001. Or 2010, IFG took over James Hay, and the task for us was essentially to rebuild the technology, to rebuild the distribution, to essentially streamline the cost base of the organisation. And we have hit every single target in doing so. We had a 5-year plan. We achieved the cost takeout in a 15-month period. We remodeled the entire product and service offering. We have then set ourselves a set of targets to rebuild what was essentially a shrinking business, first of all to growth, to break across to growth, and that has just happened in the months October and November. I think we have done so, but are only really at the starting blocks. We did so by really upping the intensity of the distribution activity, but we're really now into building our capability, expanding our product set, focusing our resources on those parts of the market which are growing, and building out partnerships with our major IFAs. So I think we are very confident that we will continue to achieve the original targets, and there is massive potential in this market as RDR changes it. Very difficult to project, but we do know there's a huge opportunity.
You've achieved your initial target to get account growth, but with spreads under pressure, how many sales will you need to get to see revenue growth?
As designed, once we break across to unit account growth, we are really, provided there isn't a significant change in pricing, we are essentially moving into revenue growth. It takes probably 12 to 15 months to flow to the bottom line. So I think we are already at that point. For us, it's about momentum. Our sales by unit have increased by 90% run rate in the last year. That will reflect with a time delay in the underlying numbers, and it's all about just getting the momentum into that organisation and then adding new services, adding new punch to your distribution capability.
Even after your £30 million buyback, the group will have a strong balance sheet and should be highly cash generative. Will the acquisition opportunities that may arise in the lower mid-tier of SIPP providers use all this resource, or are you likely to diverse into related markets?
We will have a very strong balance sheet, you're right, after the 30 million buyback. That will mean that as a business we are positioned both in the SIPP market and the advisory market to expand. We see significant opportunities to acquire clients and acquire distribution in our SIPP business, but also in our advisory business. We will use and employ our capital very judiciously in doing so. It's not about buying back books, it's about effectively becoming a distribution partner, and there may be an element of back book purchase in that case. So the short answer is essentially we see our balance sheet as supporting both sides of the organisation and developing from here.
Thank you very much, Mark. And if you would require more information, please visit the Edison website.